Your grandparents lost everything 3 times, and the people who caused it are the same ones protecting your money today, which should terrify you, because the pattern that destroyed their savings is repeating right now, in real time, with mathematical precision. And if you don't understand how they did it before, you won't see it coming when they do it again. This isn't ancient history. This isn't some distant cautionary tale from a different era. This is the operating manual for the system. You trust with your life savings, your retirement, your children's future, and the manual says the same thing every time. When the banks get in trouble, when the system teeters on the edge of collapse, when the mathematical impossibility of infinite debt finally comes home to roost, the people who pay are never the people who caused the problem. They're always the people who trusted the system, the savers, the workers, the ones who played by the rules and believed that their money was safe. And I'm going to show you exactly how this works, not through theory or speculation, but through 3 documented cases where the banking system deliberately destroyed the value of ordinary people's savings to save itself. And I'm going to show you why the same thing is being set up to happen again, probably within your lifetime, possibly within the next few years. Let me take you back to 1933, to a moment when America was on its knees, when 1 out of 4 workers had no job, when families were losing their homes and farms, when bread lines stretched around city blocks, and when the banking system that was supposed to protect people's money had spectacularly failed, because between 1930 and 1933, over 9,000 banks had collapsed, and when a bank collapsed in those days, the depositors lost everything. Their life savings simply disappeared because there was no deposit insurance, no government guarantee, just the promise of the bank itself. And when that promise broke, the money was gone, and this wasn't a random natural disaster. This was the direct result of a system designed to benefit banks at the expense of depositors, a system where banks could loan out far more money than they actually held in reserve. A practice called fractional reserve banking that creates money from nothing and works perfectly until people get nervous and want their actual cash back, at which point the whole structure collapses like a house of cards. But here's what they don't teach you in school. Here's the part that reveals the true nature of the system, because the bank failures weren't the worst part. The worst part was what came after, the solution that the government implemented to save the banking system, because in April of 1933, President Franklin Roosevelt issued Executive Order 6102, and this order did something that Americans would have considered unthinkable just months earlier. It made it illegal for U.S. citizens to own gold, and not just illegal to hoard it or refuse to spend it, but illegal to possess it at all, with the exception of small amounts for jewelry or collectibles. And the government gave people until May 1st to turn in their gold coins, their gold certificates, their gold bullion, everything, and in exchange they would receive paper dollars at the rate of $20.67 per ounce, which seemed like a fair deal except for one small detail that most people didn't understand at the time, because once the government had collected all that gold, once it was safely locked in government vaults instead of private hands, the government changed the rules. They revalued gold from $20.67 per ounce to $35 per ounce, which meant that overnight the government had confiscated roughly 40% of the wealth of everyone who had held gold. And this wasn't accidental. This wasn't a mistake. This was a deliberate policy to devalue the savings of ordinary Americans in order to reflate the economy and save the banking system. Now think about what that actually means. Think about the mechanics of what happened, because the people who lost wealth weren't the bankers who had made bad loans. They weren't the speculators who had gambled on margin. They were the savers, the people who had been responsible, who had held gold precisely because they didn't trust paper promises, and they were proven right. Not to trust those promises, but being right didn't protect them, because when the system needs to be saved, when the mathematics of debt and leverage become unsustainable, the solution is always the same. Transfer the losses from the people who caused them to the people who can't fight back. And in 1933, those people were the gold holders, the savers, the prudent ones who thought they had protected themselves, and they learned a lesson that every generation since has had to relearn the hard way, which is that in a crisis the government will always choose the banking system over the people, always, because the government and the banking system are not separate entities, they're partners, and when your partner is in trouble, you don't let them fail, you make someone else pay. But that was just the first time, that was just the dress rehearsal for what would come later, because the pattern was established, the precedent was set, and when the system got into trouble, again, they would use the same playbook, just with different victims and different methods. And if you think this could never happen to you, if you think your deposits are safe because of FDIC insurance and modern regulations, then you need to understand what happened in 1971, because that was the second great theft, and it was even more brazen than the first. We've talked about the Nixon shock before, about how President Nixon severed the dollar's connection to gold in August of 1971, but what we need to focus on now is what this meant for ordinary savers, for people who had accumulated wealth in dollars, believing that those dollars were backed by something real. And when Nixon closed the gold window, when he announced that foreign governments could no longer exchange dollars for gold, he didn't just change international monetary policy, he changed the fundamental nature of every dollar in every American's pocket, because those dollars went from being claims on a finite resource to being nothing more than promises backed by faith in the government. And faith, as we've seen repeatedly throughout history, is a very fragile thing. What happened next was predictable if you understood the pattern, because once the restraint was removed, once there was no gold backing limiting how many dollars could be created, the printing began in earnest, and with the printing came inflation, and with inflation came the gradual but inexorable destruction of purchasing power. And if you had saved $100,000 in 1971, believing you were securing your retirement, that money lost over 80% of its purchasing power over the next decade, not through some natural disaster, not through personal irresponsibility, but through deliberate policy choices made by the Federal Reserve and the government, choices to inflate the currency, to print money to cover deficits, to devalue the savings of everyone who held dollars. And this was a theft just as real as the gold confiscation of 1933, except it was slower, quieter, less visible, and therefore much harder to resist, because how do you resist something you can barely see happening? How do you protest against the gradual erosion of your purchasing power when the mechanism is hidden behind complex economic jargon and reassuring statements from authorities who tell you that inflation is necessary, that it's manageable, that it's for your own good? If this is making you angry, if you're starting to see your own situation reflected in these historical examples, then good, because anger is appropriate when you realize you've been systematically robbed. And if you're not subscribed yet, subscribe now, because this gets worse before it gets better, and you need to understand the full pattern before you can protect yourself from what's coming next. The third great collapse, the third great theft of savings, happened in 2008, and this one you might remember personally, because it wasn't that long ago and the mechanism was different, but the outcome was the same, and the victims were the same. Ordinary people who trusted the system, who believed the experts, who thought their savings were safe. And what happened in 2008 was a crisis caused by reckless banking, by subprime mortgages, by derivatives and leverage and financial engineering so complex that even the people creating these instruments didn't fully understand the risks they were taking. And when the whole structure collapsed, when Lehman Brothers failed and the dominoes started falling, the government faced a choice. They could let the banks fail and let the market clear, which would have been painful but honest, or they could bail out the banks and make someone else pay for the mistakes. And they chose the second option. They always choose the second option because the people running the government are the same people who used to run the banks, and the people running the banks are the same people who will run the government next. It's a revolving door, and the door only swings one way, from public service to private profit and back again. So the Federal Reserve created trillions of dollars out of nothing. They called it quantitative easing, which is just a sophisticated term for printing money, and they used that money to buy toxic assets from banks, to inject liquidity into the financial system, to make sure that no major institution failed. And this saved the banks, it absolutely saved them. But it destroyed something else. It destroyed the value of savings, because all that newly created money diluted the existing money supply. It made every dollar worth less. And if you were a saver in 2008, if you had been responsible and accumulated a nest egg for retirement, you watched helplessly as the purchasing power of that money eroded, as asset prices inflated beyond the reach of ordinary wages, as the cost of housing and healthcare and education skyrocketed while your savings stagnated. And this wasn't accidental. This was the explicit goal of the policy, because the Federal Reserve openly stated that they wanted to create inflation. They wanted to force people to spend rather than save. They wanted to push money into risk assets, into stocks and real estate, because that would make the wealthy wealthier and hopefully some of that wealth would trickle down, except it never trickles down, it pools at the top, and the gap between those who own assets and those who work for wages grows wider with every crisis, with every bailout, with every round of money printing. Now I want you to see the pattern clearly, because these three events, 1933, 1971 and 2008, they're not isolated incidents, they're iterations of the same basic mechanism, and the mechanism works like this. Banks and governments create a system based on debt and leverage. They encourage people to trust the system, to save in the currency, to believe their money is safe, and then when the mathematics of the system become unsustainable, when the debt can't be serviced and the promises can't be kept, they don't admit failure, they don't accept consequences. Instead, they change the rules mid-game. They confiscate wealth through legal mechanisms, they devalue the currency through inflation, they transfer the losses from the institutions that caused the problem to the individuals who trusted the system, and then they tell you it was necessary, it was for the greater good, it was to prevent a worse outcome. And maybe that's even true. Maybe letting the system collapse would have been worse in the short term, but here's the question nobody asks. If the system requires periodic theft from savers to survive, if it only works by transferring wealth from the prudent to the reckless, from the productive to the parasitic, from the many to the few, then maybe the system itself is the problem. Maybe the system needs to collapse so something better can replace it. But that question is never asked in polite company. It's never discussed in congressional hearings. It's never debated on financial news networks, because everyone with a platform, everyone with influence, everyone with access to power benefits from the system as it is, and they will defend it to their last breath. Not because it's just, not because it's sustainable, not because it serves the common good, but because it serves them, and serving them requires your compliance, your trust, your willingness to keep playing a game that's rigged against you from the start. Now let me bring this forward to today, because if you understand the pattern, you can see it happening again right now in real time, and the signs are everywhere if you know what to look for, because we're currently living through the largest expansion of government debt in human history, the United States. National debt is approaching $35 trillion, which is more than 100% of GDP, and it's growing by trillions every year. And this debt can never be repaid through normal means, through growth and taxation. The mathematics simply don't work, which means it will either be defaulted on explicitly, which is politically impossible, or it will be defaulted on implicitly through inflation, through the gradual devaluation of the currency, and that devaluation will destroy the savings of everyone who holds dollars, just like it did in 1971, just like it did after 2008, except this time the scale is larger, the debt is bigger, and the consequences will be more severe. And it's not just the United States, it's every major economy. Japan has debt over 200% of GDP. Europe is drowning in sovereign debt. China has hidden debt in its provincial governments and state-owned enterprises that nobody can accurately quantify. And all of these debts are denominated in currencies that are backed by nothing but faith in governments that have proven repeatedly throughout history that they will sacrifice savers to protect the system. So when the next crisis comes, and it will come, because the debt levels guarantee it, the playbook is already written. We know exactly what they'll do because they've done it before, 3 times in living memory, and they'll do it again because it's the only option they have left. And the people who will pay are the same people who always pay, the savers, the workers, the ones who trusted the system. So what do you do about this? How do you protect yourself when the game is rigged and the house always wins and the people running the casino are also writing the rules? The first thing you do is stop trusting reassurances from authorities who benefit from your trust. Because when the Federal Reserve tells you inflation is transitory, when politicians tell you the debt is manageable, when economists tell you the system is stable, they're either lying or they're deluded, and either way you can't afford to believe them, because history has shown us what happens to people who believe those reassurances. They're the ones who lose everything. And the second thing you do is diversify out of the system. Not completely, because you still need to function in the economy, but enough that you have options, enough that you're not completely dependent on the continued faith in paper. Currencies issued by governments with unlimited printing presses and limited credibility. This means holding some assets outside the banking system. It means owning things that can't be printed, that can't be inflated away, that maintain value regardless of government policy, and historically that's meant gold, but it could also mean Bitcoin or real estate or productive businesses, or any asset that derives its value from utility rather than from government decree. And I know this sounds radical. I know it sounds like I'm telling you not to trust the system that we've all been taught to rely on, but I'm not asking you to trust me. I'm asking you to look at the evidence, to study what happened in 1933, in 1971, in 2008, and to ask yourself whether you think the pattern has changed, whether you think this time is different, whether you think the people in power today are somehow more honest, more competent, more willing to accept losses themselves rather than forcing you to accept them. And if your honest answer is no, if you don't think things have changed, if you see the same dynamics playing out on an even larger scale, then you have a choice to make. You can continue to pretend everything is fine. You can trust that the system will protect you despite all evidence to the contrary. You can assume that the pattern won't repeat, even though it's repeated 3 times already. Or you can act, you can prepare, you can build. Resilience. You can create options for yourself outside the system. And if enough people do this, if enough people stop trusting blindly and start thinking critically about where they put their wealth and their faith, then maybe, just maybe, we can force the system to change before it collapses on its own terms and takes everyone down with it. I want to know what you think about this. I want you to tell me in the comments whether you knew about these 3 collapses before watching this video, whether you see the same pattern I see, whether you think your savings are at risk, and if this resonated with you. If this information is valuable, then hit the like button right now, because that tells the algorithm to show this to more people, and more people need to understand this. More people need to see the pattern, because the more of us who understand how the game works, the harder it becomes for them to play it without consequences. And before you go, before you click away thinking, you've heard enough bad news for one day, I need you to understand something. I need you to really internalize this, because it's the most important point of all. The pattern repeats not because it has to, not because there's no alternative, but because we let it, because we accept the narrative, because we trust the authorities, because we don't ask hard questions, because we don't demand accountability, because we allow the people who benefit from the system to also be the people who regulate it, and that can change. It can change if enough people wake up, if enough people understand the mechanism, if enough people refuse to participate in a system designed to rob them. And that change starts with information, with education, with conversations like this one. So share this video, talk about it, think about it. Let it change how you see money and power and the relationship between them. Subscribe now if you haven't already. Turn on notifications, because the next episode is going to reveal something that connects everything we've discussed in this entire series. We're going to show you the master plan, the long-term strategy that ties together the debt crisis, the collapse cycles, the digital currencies, and the theft of savings. We're going to show you exactly what they're building and why everything that's happened has been leading to this moment. And once you see the full picture, once you understand how all the pieces fit together, you won't be able to unsee it. And you'll never trust the official narrative again. So I'll see you in the next one.